Hey guys, what's up? I'm Erin and welcome back to the channel. If you've been a disciplined saver and investor, you might be in the very fortunate position that you're not only secure in your financial future, but you're also in the position where you can help the next generation. But gifting does come with its own set of IRS rules, exceptions, and a little bit of paperwork. So I'll go over some common questions that don't always get answered with the most clarity. So with that, let's dive in. Let's go over some common gifting questions that come up that we haven't really covered in the main video. Do I have to report gifts or pay taxes on gifts I receive? No, the recipient never reports the gift as income, nor do they pay taxes on it. The responsibility lies on the donor. If the gift is over the annual exclusion, $19,000 in 2025, the donor simply files Form 709 with the IRS. And again, unless they've already exceeded their lifetime gifts to you, $13.99 million in 2025, no gift tax applies. Does that, fill in the blank on whatever that is, really count as a gift? This is one of the most common questions I hear. Parents asking things like, if I pay for my child's wedding, or I pay for a big family vacation, or I buy my child a car, does that really count as a gift? Technically, yes. The IRS defines gift very broadly. Anytime you transfer money or value to someone else without receiving equal value in return. So if a parent pays $40,000 directly to a wedding venue, or they pay for a big family vacation, or they buy their child a car, anything that exceeds that annual limit is supposed to be filed on Form 709 and reported against the lifetime exclusion. But in practice, most families don't treat it that way. Instead, maybe parents pay a vendor directly and then see it as covering an event in the case of a wedding. And they never file Form 709 with the IRS. And honestly, the IRS doesn't really have a way of tracking these payments. So unless you're dealing with a very large estate where gifting strategies are being used to reduce estate taxes, one-off expenses like weddings or vacations are unlikely to ever raise a red flag. The key takeaway here is that by the book, yes, these situations or events are gifts, but the vast majority of families do not treat them that way, and enforcement outside of truly high net worth estates is very rare. What if my parents buy me a car but keep the title in their name? That is not seen as a gift. So long as the car is titled in their name, it is their asset. It becomes a gift when the title is transferred to your name, and at which point it would be the value of the vehicle at that time. What if I pay off my child's debt, like a credit card? This would be seen as a gift. Even if you pay the lender directly, the IRS would look at this as a gift. But depending on the amount, again, a lot of parents wouldn't report this. What happens if I gift stock instead of cash? If you give stock, the value of the stock or mutual funds on that day is what is treated as a gift. But there is one important thing to hold on to. The person you're gifting it to also inherits your original purchase price as their cost basis. Let's say you bought Apple when it was $50 a share, and it was worth $200 a share when you gifted it. Your child's cost basis is still $50. That means when they sell, they owe capital gains tax on all of that increase from $50 up to the sale price. But here's the wrinkle. If instead of gifting the stock during your lifetime, you leave it to your child when you pass away, the rules change. These type of assets, when inherited at the time of death, get a step up in basis. So the value for your child or their cost basis would be the value on the date of death. In this example, if Apple is worth $500 when you pass, your child's new cost basis is $500. If they sell right away, there's no capital gains tax at all. That's why in a lot of situations, it can make sense to hold on to highly appreciated assets and pass them on through your estate rather than during your lifetime. What if the donor passes away after making large gifts? When someone dies, the IRS adds up two things: the gifts they made during life and the value of their estate. Gifts above the annual limit reduce what's left of their estate exemption. But here's the important point. As long as the total of these two, the lifetime gifts and the estate, fall under the lifetime threshold, there is no estate tax or federal gift tax due. So for most families, this is not a concern. There's another strategy worth knowing about if you're thinking about large transfers, and that's using an intrafamily loan. Here's how it works. Instead of gifting your child a lump sum, you can loan them the money. The IRS sets a minimum interest rate each month called the applicable federal rate, AFR. These rates are usually very low compared to what a bank would charge, and as long as you charge at least that rate and document it, it's considered a real loan and not a gift. Now here's where things get interesting. Over time, you can forgive portions of that loan using your annual exclusion. For 2025, that means you could forgive $19,000, or if you're married and splitting gifts, that would be $38,000. So effectively, you would be helping to chip away at this loan balance without ever touching your lifetime exemption. Let's take an example. Say you loan your child $200,000 to buy a home. You set it up with the IRS required interest rate and a payment schedule. Each year, you forgive $19,000 of the balance. Over a decade, you could forgive nearly $200,000 tax-free, and the IRS sees it as a legitimate loan gradually being forgiven under the annual exclusion. This approach does require paperwork and consistency. It does have to be a documented loan. You do have to charge the AFR interest rate, and you do have to have payments over time. But when done right, it can be a smart way to help with big expenses without ever touching your lifetime exemption. Here's the bottom line. If you've worked hard, saved diligently, and invested wisely, reaching the point where you can help your kids or your grandkids financially is a true blessing. So whether that's a down payment on a home or tuition for college or simply giving your children a financial head start, gifting is one of those meaningful ways where you can really see your money make a difference in real time. The rules can feel complex, but for most people, what it boils down to is pay attention to the annual exclusion, file Form 709 with the IRS if you go above it, and then just know that the lifetime exemption is so large, it will likely never affect you. You'll never pay gift tax. So what are your thoughts on gifting? Leave them in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. And then beyond that, it's just being fortunate and, not fortunate. Sorry. Just say grateful. I don't know. Giving cash, that's a gift. I'm trying cash, credit card, car, home. I want to say all of those. For most families, sorry about the hands. I know, it's a problem, but still. Buying a car, titling it in their name, it did make me feel better when I was with the money guys, and I was like, I'm sorry I moved my hand a lot. Bo was like, well, I've backhanded Brian like 5 times in our conversation. So I think it's just a thing on YouTube. It does actually help keep people watching the video if you move your hands. So the IRS sets a minimum interest rate each month called the applicable. I never realized how hard it is to talk until I'm on camera. In life, I swear I talk so well.